manipulation of the market is going to come to an end, and they know it, and they're desperate, and it's very difficult to see how they can square their books. So, if you've been victim of this continual manipulation of the market, you may be laughing. I think the whole thing is actually very, very sad insofar as it had to happen. But given that it had to happen, thank goodness it is now finally happening.
This is Dunnigan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty in Finance. We have a returning guest, Alasdair MacLeod. He's the head of research at goldmoney.com, and he joins us this Monday, May 24th, 2021. Alasdair, thank you again for joining us on Liberty in Finance.
Thank you for asking me, DK.
Our viewers are after me, badgering me whenever we don't have you on for a week or two to have you back on. So that's why I'm calling you a little bit more frequently these days, is because we just feel that at times of potential changes, we want to get your guidance and your perspective on what's developing. Also, you've teased us now for about a year with your expectation that we may be closer than most people are realizing to a serious disruption in fiat currencies, the banking system, and so on. We want to stay close to our ear to the ground on that with your help. So that's another reason we would like you in our corner frequently and appreciate you accommodating that. We have a question that arises from an interview you just did last week with Craig Hemke on the TF Metals Report last Thursday in his Thursday conversation segment, which I found very engaging. Folks, if you haven't taken that in, you should go over that. In fact, I'll put a link to it in the description of this video. But in that, you were discussing with Craig the potential ramifications and implications of the Basel III provisions that go into effect for some banks, which you can clarify here, at the end of the month of June, and then for other banks at the end of the year, and why you think that if this plays out, it may actually be very significant for the metals industry, for investors in general, for the rule of law, and whether you think, in fact, it will play out for pretty much those same reasons, because it seems like the rule of law has been frightfully absent from a lot of our not just financial, but political arena for some time. So could you start there and explain in layman's terms as much as you can what the impact or the implications are of some of these rules, where they came from, what they are, when they're supposed to go into effect, and what you think the impact of them would be?
Yeah. Well, the first indication we had of this was in the spring of 2014, when the committee that puts together the Basel regulations, which are the sort of, if you like, the overview regulations, which can be modified by local regulators, but basically they have to stick to the spirit of the Basel regulations. And Basel III was designed, if you like, in the wake of the Lehman crisis to try and ensure that counterparty risk didn't spread amongst banks, because obviously this is a huge issue, and everybody realized at the time that, my goodness, if the American authorities hadn't stepped in various of these instances, there would have been a complete global crisis. I mean, we had it developing in the German banks, for example, who had taken a lot of mortgage debt, American mortgage debt, on their books. Ireland, the Irish economy, which depended so much on, the sort of international banking, European international banking, basically just turned turtle. It was just they ended up with the most massive debts, partly because their own banks collapsed in all this and they had to be rescued and so on. So obviously what Basel III had to do was to deal with this systemic risk. So if a bank goes under, and remember also that the G20 agreed to a change in the basic rules, that instead of bailing out banks, they were going to bail in banks. Now, the difference between the two is a bail-in, basically, people like bondholders and all the rest of it, they take the pain. The governments aren't meant to take the pain. The depositors, under whatever the figure is, £85,000, $125,000, I think, in America, whatever the figure is, the small depositors get bailed out, but everybody else can, make their own arrangements. Tough. But obviously, if you're going to do that, then you're actually making the systemic risk problem even greater, because the moment you get a problem, what happens to all the bank bonds? The bondholders just get out of every bank bond you can imagine, and then one stable source of financing for banks is effectively removed from the scene. So you're going to, bailing in actually sort of makes the problem a lot worse. So
let me just see if I understand that. You're saying that the transition from a government bailout plan, which sounds pretty good to the common man on the street, it's like, other than unfairness, it's like, oh yeah, the bigwigs get bailed out. But what you're saying is at least the ordinary guy doesn't feel immediately a threat from it. Whereas bail-ins is basically putting everybody on notice. Either you should better do a run on the bank, or if you want to save your own skin, you better get your skin out of the game from if you see the sniffing problem in the bank system.
Yeah, large depositors as well. I mean, people who don't have that guarantee that is only extended to smaller depositors. So, I mean, this is an absolute nonsense. I mean, I don't know how buying a house works in America, but basically, the money goes into the lawyer's pot. There's a lawyer's client account. Now, I just imagine under these circumstances, a lawyer's client account probably has tens of millions sitting in it, in transfer between house purchases and house sales and all the rest of it. That would get wiped out under these circumstances. I mean, the knock-on effects of banks not being bailed out by governments are really, it's just stupid. And obviously what governments are trying to do is they don't want to be lumbered with the cost of bailing out their own banks. They'll license them to print money, but they don't want to bail them out. I can understand that. But you can see that from the Basel Committee's point of view, they have got an extra task as a result of that. So they take this extremely seriously. So go way back in the spring of 2014, they put out a paper for consultation, and that was this new net stable funding ratio. Comments were invited, and presumably they were offered. And the following October, out came the definitive paper. This is the net stable funding ratio, and this is the way it works. So, we've known since 2014, 7 years ago, that this is going to be introduced, but only now has it suddenly become urgent. And where it has hit precious metals is that the London Gold Market Association has found that it is being given no leeway whatsoever. Its members will find that they can't finance one side of the balance sheet out of the other. I mean, and by that I mean, they can't use, let us say, obligations to customers in unallocated gold to offset the other side of their balance sheet in gold. So, and then there's a haircut of 15% in effect. It's basically, the intention is to ensure that long-term assets are financed by long-term liabilities so that you can't have a run. Short-term assets are financed by short-term liabilities, with some exceptions. Your gold position can't be financed, and I'm talking unallocated gold incidentally, can't be financed by gold on the other side. You have to eat up, if you like, the credit on other aspects of your funding in order to pay for your, the assets that you show on your balance sheet, which are gold or silver or indeed commodities. So this really means it is uneconomic for people, for banks to run bullion desks anymore. That's the nub of it. It's also it also cuts a swathe through the idea of the London Precious Metals Clearing Limited, which is basically owned and operated by four banks, four of the largest banks. Because they always end up with imbalances, and those imbalances will show on their balance sheet, and they're likely to withdraw from the LPMCL because who would want to do it, under this new regime? So what we've found, first of all, is that the European Banking Association is imposing these regulations on the banks it regulates and their subsidiaries, wherever they might be. So, if they have a subsidiary in London dealing in gold and it's not the parent, it looks through the whole arrangement. So, anything which is owned by a European bank regulated by the European Banking Association has to comply with the new net stable funding ratio regulations from the end of this current quarter. And that is literally, 6 weeks away, 5 weeks away? So that's very, very soon. The Swiss banks, in effect, having to fall into the same regime. So from that date, they will also be looking to do the same thing. The UK is introducing these regulations on the 2nd of January 2022, or 1st of January 2022. And so that means that the banks which are regulated by the LBMA, wherever they are, if they're not already having to comply with these regulations, will have to comply with these regulations by the end of this year. And in practice, what that means is that banks with trading desks dealing in gold, silver, platinum group metals, oil, other commodities, and all the rest of it, because it covers the whole gamut, will find that they have to stop dealing by the end of the year, or be prepared to absorb the balance sheet penalties if they want to continue to trade. And in practice, they'll turn around and say, well, we've got better things to do. So, because, they can make money trading on COMEX, for example. And that's absolutely fine. It's running uneven positions. So you can't net one thing off against the other in its entirety. So you're going to have always an element of balance sheet, which is expensive to finance. And for bankers, that's a no-no. So that's basically the situation. Now, if this leads to the LBMA, in effect, stopping all unallocated gold business, which is actually basically all they do, there is a little bit of allocated gold business, but that is almost sort of, sneaks in and out underneath the radar. But the unallocated gold business is the vast, vast bulk of everything that is done. All this trading that goes on, that settle 30 million ounces a day on average, turnover is probably closer to 600 over the day. All that is an unallocated gold. So that shuts down. Now, what that means is that those players are also going to shut down their positions on COMEX. So at the moment, there are 43 banking members of the LBMA, and on COMEX, last time I looked, there were 17 swaps, which is where these guys are, who are long, and there were 27 who are short. So we're talking roughly the same sort of number. So in effect, what happens on COMEX is that the only non-spec side, apart from a few market makers, but the only non-specs providing liquidity into the market are producers, in other words, the mines, hedging forward production. And at the moment, if you look at the makeup of the commitment of traders figures, you see that roughly 74% of the liquidity on that side actually comes from the swaps, and the balance is coming from the producers. So this market is, the COMEX market is just going to contract into an illiquid waste of time. It really is. So you can see that, effectively, that GC contract is going to close down. The silver contract effectively closes down, there's so little liquidity that you wouldn't really call it a proper contract in today's terms. And so really what I'm saying is that the knock-on effect of this Basel III net stable funding ratio rule is basically to shut down the derivative markets. This absolutely has severe consequences for the gold and silver market, the wider market, because essentially you've got around about, I think it's from memory, $340 billion worth of open positions. That was the last recorded figure we had, which actually was the end of last year. And this is the Bank of International Settlements figure. So you've got about 340 billion, which, the supply for that is going to go. So given that absorbs demand, where's this demand going to go? I mean, the demand is going to, presumably, some of it will just disappear, but some of it is going to go into the physical market because some of it thought that it had exposure to the gold price. It will no longer have exposure to the gold price. So I think this is actually quite a consequential development, and it's something we ought to be following very, very closely.
Can you clarify on this? Sounds remarkable because we've seen so many things happen. You and I were talking about before we started the DOJ declaring the precious metals trading desk of JP Morgan as a criminal enterprise, and yet on business goes now months and months after that. People have gotten a little bit jaded. People in the bleacher, the cheap seats, have gotten a little bit jaded at seeing what appears to the ordinary eye to be unsavory practices going on year after year, decade after decade, without any punishment or whatever. So who is this body that can write these Basel III regulations that would potentially cause all of these bullion banks to stop doing metals futures? I mean, it's not the banks doing it to themselves. Who is it that's writing these regulations?
Well, it's as I say, it's the Bank of International Settlements, which, if you like, the central banker's central bank, and it's a committee underneath the FSB. I can't quite remember. It's something financial something board, stability board. That's it, which is a committee within the Bank of International Settlements offices in Switzerland, and so they are the people who have come up with these new regulations. And it's interesting because one's gut reaction is that this is essentially an establishment organization. I mean, the top establishment organization in the banking scene, who basically, if you like, sort of think the world is entirely fiat currency and would dismiss gold, if you like, as an alternative to the dollar. And furthermore, would be encouraged to do so by the American Fed and the US Treasury. I mean, we've seen this in the past. So aren't they, isn't the establishment shooting itself in the foot? That's the question which really arises from this. But I think the way to look at it is just imagine yourself in the shoes of someone given this task in that committee. You will be aware, perhaps more aware than general members of the public, of the shenanigans that go on in the derivatives markets. And if you are aware of what's going on in derivative markets and the crookedness and the spoofing and all the rest of it, then surely that is a source of enormous risk to the international banking system, and it has to be cleaned out. And I mean, I've been thinking about this, and I think that is basically the answer. The interesting thing is that as far as the Prudential Regulatory Authority, which is our bank regulator, is concerned, I don't think they can come to the rescue of the LBMA on this either, because I mean, European regulations are coming in within 4 or 5 weeks. It is inconceivable, really, that the British regulator would fail to follow the European regulator on this. I mean, I just sort of imagine, the whole thing would just get absolutely nonsensical, because quite obviously the regulator will be leaning over backwards to allow business which, as far as the Bank of International Settlements is concerned, they have labeled as risky and needs addressing. So I can't see that the PRA has got any alternative. I mean, the reason this really came up was the PRA actually decided to consult the industry, and the consultations had to be in by the 3rd of May. The LBMA wrote a letter which basically said, with the support of the World Gold Council, that, unless you do something about this, we're going to be out of business. I mean, it was almost as blunt as that. You didn't have to read between the lines, for goodness sake. So, this was absolutely clear. And I must admit, that sparked my interest in this, because I thought, no, hold on a minute. This is very, very serious. So I decided to really look into it, particularly because I'd heard a certain amount of commentary on it. And it seemed to me that the commentary, in a sense, it's understandable. It was misinformed, because the whole situation is actually really quite complex. And we're talking about deep regulation, and we're talking about bank speak of the sort that nobody actually usually bothers to try and understand. But
we rely on you to be our interpreter, Alasdair.
Well, I thought it was high time I did something for to look at this and try and put the record straight. So anyway, that is the conclusion, and it looks to me like really from the the third quarter of this year, in other words, following the end of June, the derivative world is going to sort of evolve into a very different place, because the UK banks, the members of the LBMA, are not going to hang around until the end of the year. And we've got an immediate problem, and that is if you look at COMEX. Now, this is the visible side of it, but if you look at COMEX, the swaps, which are the bullion bank trading desks, are net short of around about $29 billion worth of gold. And they're desperately trying to close it. I mean, look at the way the gold price is behaving today. They want to bang it. They want to get it down, because the active contract is running out. It's rolling out. This is the June contract. And there are lots and lots of option positions. They want to expire worthless. I mean, this is what they do. So this sort of, manipulation of the market is going to come to an end. And they know it. And they're desperate. And it's very difficult to see how they can square their books. So, if you've been victim of this this continual manipulation of the market, you may be laughing. I think the whole thing is actually very, very sad insofar as it had to happen. But given that it had to happen, thank goodness it is now finally happening.
And you believe that it will, because here's a question. This is typical of the 80 odd questions that have been submitted for you. About half of them are of the following tenor. Alex Heldenby says, regarding the Basel III unallocated gold proposals, it would be unusual for the big banks not to get their way in closed door negotiations. Why do you think it's unlikely in this case, or could there be a last minute reprieve?
Yeah, that was my sentiment as well. But the more I look at it, as I say, if you look at it from the point of view of the Basel Committee, they've got to clean this one up. And also the fact that it is coming in at the end of June for Europe, quite simply, there isn't time. There isn't time now. I mean, this is going to happen. So, and when it happens for the European banks, it's going to happen for everybody else. I mean, it's only just delayed by 6 months. And basically, it's 6 months for everybody to close down their unallocated gold business. It's the end of unallocated gold business in London. And high time too, because the LBMA in their letter actually, I think, were marginally dishonest in their approach. They described unallocated gold as gold. It's not gold at all. The way it works is very, very simple. You can create a credit to give to as a bank, to give to your dealing desk to trade in gold. I mean, it's very, very simple. And you can show it on your balance sheet on either side, if you want, as unallocated gold. So this is not gold. This is money. This is currency.
Currency, please. Thank you.
Yeah, currency. Okay, right. I'm going your way on this currency story. Anyway, this is currency, credit currency created out of thin air, which just happens to market to the gold price. That's all it is. It's not gold. And it's fundamentally dishonest. And furthermore, the way in which they have approached this, they could have done a slightly different thing. They could have turned around and said, okay, this is not gold, this is a derivative. But to get the LBMA to agree that this is a derivative and not gold, that opens a huge can of worms about the whole process. What actually is the LBMA doing? What are the members doing? What are they trading in? I mean, this idea that you trade for forward settlement, unallocated gold is meant to be convenient. Oh, come on. This is absolute rubbish. If that was the case, where are they storing this unallocated gold? It doesn't exist. I can tell you that the gold liquidity in London is just a few hundred tons, no more than that.
I just have to keep expressing the same sentiment, and that is I'm feeling, I think what a lot of people are about this real split feeling. One is terribly excited that truth and honesty may reassert itself, and terribly skeptical and jaded that it never does so, it never will. So you honestly judge that, yes, if these provisions play out, we will get a fundamental shift in the landscape of how the metals market is run, that will be more based on what really exists rather than all these shenanigans that you've been describing. And you also truly believe that this will play out?
Yes, I do. I mean, it's getting to the point. I mean, like everybody else, I've become so cynical about the system. I'm with that cynicism entirely. But really looking at this, I'm finding it increasingly difficult to see how this cannot end, as it were. I'm finding it increasingly difficult to see how this unallocated gold trading, which is a complete myth, which the committee understands, incidentally, how it can continue. It's got to come to an end. And this is the important thing. We've got, the whole of the sort of the bank risk thing is actually now so important, particularly in the wake of COVID, because the bad debts, I mean, particularly in Europe, the bad debts are mounting hugely. The bad debt situation in America is understated. From all the information I have, with small businesses, small and medium-sized businesses throughout the nation, 25% of them wiped out, I would think is probably a conservative guess. It's only really the big businesses who've, had sort of lots and lovely subsidies and kept going by the banks because the banks don't want them to go bust. In other words, all the zombies are still there. But the real productive side of the economy has, been decimated. There actually should be a word for 25% removed rather than just 10%, which is what decimated means. But anyway, so under those circumstances, how can bank regulators backtrack on this situation? I really cannot see how they can do it. And now, the European Banking Association, I think, is probably, I don't know, it's difficult to say. Local bank regulators in Europe are great ones at kicking the can down the road and trying to remove a problem from their patch, as it were. And they've been using Target 2, the Target 2 settlement system, to do that. So what they do is they turn around and they say, these non-performing loans will say they're performing so that you can use them as collateral to borrow money from the central bank. That's the way the Banco d'Italia and the Spanish central bank have been feeding money into their banking system, taking basically, bust collateral in exchange. And so it pushes it into the Target 2 system. So we're looking at a Europe which is already, from the regulatory side on a local basis, completely corrupt in the way it behaves. So how can the European Banking Association have any credibility as a regulator, effectively of the regulators. But it's turning around, and within the next 5 weeks, anyone trading in the gold market, on unallocated gold, are going to face effectively financial penalties. Now, I mean, it could be that the European Banking Authority are still fighting the Brexit battle. I don't know. But I think one thing is absolutely clear. This is going to happen, and London has no alternative but to follow.
All right. So for the sake of discussion, let's imagine that the almost unimaginable does happen, and some of the major industry of hijinks and goes no longer in business. Now, what does that do? What is the real impact of that? We have a question. This, again, represents many questions. Justin Reynolds says, what will Basel III do to gold and silver prices? Your thoughts on how this plays out?
Well, I mean, the first thing that comes out of this is that a lot of people, particularly customers of banks, have gold accounts at the banks, and they have been persuaded to have unallocated gold accounts, which basically means, well, I mean, it's because, you go along to a bank and let's say you've got a few kilos of gold and you say, I want to open a gold account with you. They will dissuade you from having an allocated account where the bank actually acts as custodian. And they'll dissuade you by saying, well, the costs of running this account, you're going to find it actually quite uneconomic. I mean, I think we pay something like 18 basis points, something like that, to store gold. I mean, depending on where it is. But a bank will charge you, I mean, something closer to ETF levels. Two reasons. Firstly, yes, I mean, acting as custodian does mean that they have responsibilities. But the main thing is they would rather you were a creditor of the bank rather than you a depositor of something in custody. Because the moment you're a depositor, you are a creditor of the bank, you don't own that gold anymore, and the bank is free to do what it wants with it, which is what happens, basically. So a lot of these guys think they have got gold exposure by having an unallocated gold account. Now, when these banks stop offering unallocated gold accounts, which they will just withdraw from the market. They will say, we're no longer offering this service. I mean, from time to time, we've had people like ABN AMRO turn around and, when they've had difficulty getting hold of gold, whatever, to help sort of offset the risks on their gold accounts, they've turned around and said, we're no longer offering this service, and they close it down, whatever. Or the other way in which they do it is they've turned around and said, we can't pay you out in gold, we will only pay you out in the cash equivalent. So you get these problems. Now, we're looking at huge quantities, as I say, sort of somewhere between $300 and $400 billion worth of unallocated accounts, and also COMEX futures accounts. So that soaks up demand. The supply soaks up demand. Remove the supply, what happens to the demand? A lot of that demand undoubtedly will disappear because if the bank shut down your account and won't offer you any other service, you probably go elsewhere. You probably don't do it anymore. I don't know. But a lot of people are going to want to buy gold, and they're going to want to buy silver, and they will go for physical. But there isn't really very much liquidity in gold and silver markets at the moment. I mean, silver has been a story in the headlines recently, but it's also true of gold. So what does it do with the price? I mean, the only thing I can think is that the price is likely to be driven sharply higher as these banks remove their account facilities for unallocated accounts. And it doesn't just stop there either, because the same treatment is extended to banks dealing in other commodities, derivative positions in other commodities, particularly energy and things like that, copper. What a time for this to happen, because that, insofar as it drives up the prices of these things, we have got an inflation problem in the sense the purchasing power of paper currencies is going into the toilet. I mean, it's the only way to put it. And then you get this happening. It's not good timing. But as I say, when they started doing this, it went out for consultation in spring 2014. It was a very different world then.
Yes, in fact, that was near the low. By the end of 2015, we were at the decade lows for precious metals. So what a difference half a decade makes now. And yeah, exactly what I was going to ask you is this a perfect storm brewing right now then in the very near term, like the next quarter or two, for, you've got unprecedented debasement of the monetary supply in the U.S. at least, and other Western countries, trillions per year, et cetera. And then you've got commodities reflecting that, or because of pent-up demand following the lockdown, whatever, you've got commodities bursting out into what the Aden sisters are calling a commodity super cycle, that sort of thing. And at the same time, you've got regulations that were written 5-6 years ago, basically 7 years ago, shutting down the manipulative futures operations of some of these major players. That sounds like potentially, fuel and ignition source. But
what's the response going to be? This is interesting, because what we would normally expect is we'd expect perhaps the central banks to come together. I'm talking about the Western central banks, of course, to come together to form a new sort of, if you like, selling cartel to try and sell physical gold into the market to satisfy demand, to keep the price down, if you like. I'm sure that's what the Americans would like. I think the ECB would like that. But I really don't see the Germans, the French, the Italians, who are the big holders in Europe, willingly going along with that. And the other thing there are two further elements in this. I don't know if you remember back to 2002, there was a guy called Frank Veneroso, who I wrote about this in the article, actually, we're talking about. And Veneroso did a lot of work trying to track down how much central bank was leased or swapped into the market. And he based this on a number of conversations he had with a guy called Terry Smeaton, who I actually knew. I used to have lunch with Terry Smeaton in the Bankers Club. And in those days, there was a point, actually, Veneroso was absolutely right that this, physical gold was going out of the central banks into the market and then disappearing. The Bankers Club, where Terry and I used to lunch occasionally, literally backed onto the rear entrance of the Bank of England in a street called Lothbury. And you would see security vans going in and out all the time. They were obviously carting gold to and fro, mostly out, I guess. So, yeah, that's what was happening. I'm not saying it was the Bank of England's gold. Well, it's actually the UK Treasury's gold. But it certainly would have been arranging leases for other central banks as a means of defraying the cost of storing gold in the Bank of England, if you like, with the Bank of England acting as a custody of their earmarked gold, which is the technical term they use. But what Veneroso came up with was he reckoned that at that time, anything between 10 and 16,000 tons of central bank gold was out on lease or swap. Now, that 16,000 figure was roughly half the total central bank gold reported as monetary gold, part of national gold reserves around the world. Now, I don't know what's happened to that situation. My guess is, and from what I've been told by other sources, is that the gold doesn't actually leave the Bank of England so much anymore. I don't know that it stays there entirely. I don't know whether it's just part of it stays in the Bank of England, but basically they work more off a book entry system. And I think the reason that it has changed is that instead of just selling physical gold into the market. I think we're now in the realms of a sort of financial situation. I mean, it's really sort of trying to sort out problems in either the futures market or the forwards market or whatever, rather than the old situation, which was very, very different. Because what happened in the old days was a bullion bank would lease some gold off a central bank through the Bank of England's auspices, as it were, and sell it into the market, buy US treasuries, and ride the treasuries for 6 months and then reverse the transaction or roll it subsequently. And basically, the cost of leasing the gold was less than 2%, and the return you're getting on US treasuries was 6% plus. So this was a lovely carry trade. I mean, that's what it was basically being used for. That carry trade can still continue, but of course, it's gone the other way. I mean, you can't really get any yield pickup by, say, leasing gold in order to put it on deposit or to buy US T-bills, for example. So that has fundamentally changed. But what we don't know is how much of this central bank gold is out on lease or swapped at the moment. Now, this is another problem, because on the demise of these derivative markets, how are they going to get back that gold? Put another way, with gold already out in the market, probably in fairly large quantities, do the central banks have the ability to sell further gold into the market in order to suppress the price? I suspect the answer to that is no, or they will be unwilling to do so. Then there is another aspect to this, and that is that these shortages of gold in the West are the natural consequence of China's campaign to become the most important gold producer and physical gold market in the world. And as well as that, I have admittedly assessed that they have acquired something in the region of 20 to 25,000 tons before they authorized their own citizens to enable them to buy gold and silver bullion. And that was in 2002. Since then, I think it's commonly estimated that the Chinese population, as opposed to their governments, have accumulated over 17,000 tons of gold. So you can see that of what we would call monetary gold, the vast majority of it is now in Asia, because you've got the Indians as well. You've got the Russians, who are major producers, and they stopped using the dollar basically as the sheet anchor to their foreign reserves quite some time ago. Gold is now their sheet anchor, as it were. So you can see that of the monetary gold that's actually around, or gold which could be monetary in the sense that it is being hoarded against the day when fiat currencies fail or lose purchasing power or whatever, as opposed to being in jewelry or for industrial purposes, really, these markets, that market is now controlled in Asia. And this brings in a geopolitical aspect. If America wants to try and hit the gold market again with another series of sales, she knows that she's on a hiding to nothing. So what can they do? I can't see they can do anything other than try and push out the story that, well, gold was yesterday's story, pet rocks. I don't know why you bother. We're not interested. We don't care. And I think that's probably the line they're going to have to take.
The question, this is now a third vein you've opened up here, that a whole bunch of questions have been asked along this vein, and that is Entanglement Entropy says, there are a handful of countries with essentially zero gold left in their central banks. There's certainly some interesting stories behind that. Canada is a glaring example. What options will these governments have after a fiat collapse?
Well, none. I think it's the answer. I mean, the problem, what do they do? The problem is that at the heart of a fiat collapse is the dollar. It's as simple as that. Now, we don't know how much gold the U.S. Treasury has. I mean, at the moment, there's a figure on the Fed's balance sheet, which basically is valued at $42.22 an ounce. It's a myth. We don't know how much is there. We don't know how much has been sold into the market already. I think probably quite a lot. But it's a state secret, so we're not allowed to know. So, but currencies like the Canadian dollar are actually tied to the US dollar. If the US dollar fails, the Canadian dollar will fail with it. And I think the situation we're looking at is that with a monetary hyperinflation in the dollar, I mean, I reckon you're already hyperinflating. You've only got to look at President Biden's plans and all the rest of it, on top of the COVID and stuff, and the undoubted difficulties which everybody is playing down of the US economy and the global economy. I mean, the only alternative is to accelerate the rate of monetary production, printing of money. We are in the realms of hyperinflation as far as the world's reserve currency is concerned. And any currency which is tied to it will go down with it. There is obviously a way out of this, and that is at some stage, other countries will abandon the dollar as their number one reserve currency and instead make their currencies convertible into gold. So they'll have to mobilize what gold reserves they've got. But here again, I mean, how much is leased out? At the moment, there's something like 35,000 tons, allegedly, of monetary gold in the central banks and the treasuries all around the world. How much of that is there? We don't know. I mean, it could be, according to Veneroso's analysis all that time ago, 20 years ago, there might only half of it might be there. But as long as there is some there, you can turn a fiat currency into a gold substitute. But you need to do it properly. My guess is they won't do it properly. But doing it properly involves not just a bullion standard, but also having gold coins. So that in the case of the UK, for example, our sovereigns and half sovereigns and quarter sovereigns would then come back into circulation and be exchangeable at any bank for notes. So, but what the rate would be, goodness knows. I mean, how many pounds it would have to be for that to stick is another good question. I think that's the end game. That's the only end game, actually. But, history shows that the state is always very reluctant to give up control over money once it's got it. It will hope that it can do central bank digital currencies and bypass the banks who have undoubtedly made life more difficult for central banks because they pursue their own agenda, which is quite natural. It's difficult to know. It's difficult to see any bank, any central bank, actually giving up on fiat currency. Sort of throwing in the towel and saying, "We got this wrong. We've got to get out of this, and the only way we're going to get out of this, basically, is to make our currency convertible into gold." And of course, you've got this huge reluctance in America to do it, not just because, I mean, everybody's a Keynesian now in the system, but think of the power you're handing to China. I mean, this is really this. I can just see every objection from the deep state about such a move. They're going to have to come up with gold. I mean, at the end of the day, that's what's going to happen, basically.
Everything you're saying this year is very likely to play out to be an extremely eventful year. Our subscribers and viewers are just trying to figure out which way is this chessboard tilting so that they can make sure that they don't get clobbered by everything that's going to be falling on people who don't wake up. So we're wanting to keep you here and giving us that awareness so that we can be aware and prepared. Alasdair, if people want to follow your work on a daily, weekly basis, where should they go?
Gold Money publishes my articles on a Thursday, every Thursday. So goldmoney.com and hit the research tab and insights, and you'll find it there. And that comes out sort of early afternoon, Eastern Standard Time. And I write a market report on precious metals, which is published at about the same time, but on the Friday. So those are the two main writing activities I do.
Very good. And folks, so that you don't lose track of us with any interviews with Alasdair or any of our guests, make sure you go to libertyandfinance.com. Over on the left-hand side of our homepage, libertyandfinance.com, put your name and email address, sign up for our free newsletter so that you get all of our interview links and all the descriptions with any resources that our guests provide. And Alasdair, as always, on behalf of all of our viewers, just thank you for joining us here on Liberty and Finance.
That's my pleasure, DK.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.